Hello everyone, welcome to the live trading strategy workshop with me, Janne Muta, Chief Market Analyst for TO Markets. And as this is a workshop, it basically means that you can ask questions whenever you feel like, and then I can answer those now or later on after my slides. So, but before we go to the actual material that I have for you today, I just want to go through a couple of housekeeping things. And first of all, obviously, you need to know why should you be here listening to me. Obviously, I do understand that you are busy, you have things to do, you have trading attend to, but why should you be here? Why should you assume that there is some added value to your trading with this webinar? So I'm just going to point to tomarkets.com/analysis. That's where I have this live track record for you to go to and verify what I do. Week after week, we are hitting the targets. And this is basically because I am giving you setups and I'm giving you analysis beforehand. I don't want to be one of those analysts who come and tell you what happened yesterday and why it happened, because that's what the financial journalists do. They tell you the reason for the price moves. And sometimes that can be relevant also. It's good to know why the market reacted the way it did. But also, it's highly important to have trading setups that are valuable and setups that you can learn from and you can sort of integrate into your own analysis and take advantage of. So go there, verify what I do, go to tomarkets.com/analysis, and then you know if it's worth following what I do or not. Okay, but first of all, even though we do hit these targets, please do remember that all the views expressed in this presentation and in our analysis are just our opinions only. And they are made available purely for educational and marketing purposes and do not constitute advice or investment recommendation. So if you agree that this is only marketing material, this is only educational material, then we are good to go and move forward. You should also take a screenshot of this disclaimer text here, read it through, or pause the video if you're watching this afterwards. Read it through and make sure you can agree with the disclaimer. Now, here's my background. I started in the end of 90s as a futures trader in London. I've been working in various jobs in the industry after that. And now again at TO Markets, it's my duty to provide you with good market analysis and trader education. And this is what I love to do, really. It is actually managing a fund. It can be kind of lonely sometimes, but when you get to talk to traders in webinars and you can do analysis on a daily basis, I think it's much more exciting, actually. So in this workshop, you will learn some basic things because we have to cater for people who are still in the beginning of their trading careers. But also I know from experience, I started in 1998, so I have 20 plus years of experience in financial markets and trading. So I know from experience that it's sometimes good to go back to basics. They sometimes clear your mind from all the clutter that you see in the markets and in different videos and different analysis articles. Because people have a tendency to complicate things. So it's better to go back to basics every now and then and reevaluate what we are doing. And also, one more thing on this. I can't remember the name, but just recently I was listening to a podcast of a highly successful trader who said that it's amazing how simple things work the best. Financial industry has this tendency to create complicated things that sort of suck in the client and create a bond between the analysts or the sort of so-called professionals and the clients. But it's really the simple things that work the best. So let me go through some of the basic things here in this webinar to help you to understand what works and why it works, and what are the weaknesses and strengths of those approaches actually also. So we identify trending price action, understand that after this webinar you can understand why certain trade entries are better than others, and also a couple of strategies to entering into trades at key price points. Obviously, we can't cover everything in this webinar, but there'll be other webinars in the future, so you are more than welcome to join them. Now, you might have this experience that there are challenges in identifying trending price action. It sounds simple, just trends your friend until the end in the end and all that jazz, but it is sometimes challenging. And why is that? It's because markets are evolving. There is more computerized trading. There's more participants. There's more back and forth between the participants. I was just listening to an audiobook lately with, and there was this highly successful fund manager who had been trading since the 70s, and he said that really a lot of the things that used to work in the 70s and 80s really don't work anymore. And one of those was trend lines. And you can find sometimes that trend lines work, but there are a lot of times when they don't. And those times are the problem. If we have a tool that works sometimes, but most of the time is kind of vague and little difficult to trust, then what is good? What's and there's no point in having that sort of a tool in your toolbox, really. So I'm going to draw your attention to something very simple. What I'm trying to give to you, what I'm giving to you is kind of trying to get to the essence of trading. You need to be able to find price levels, and you need to be able to time the market so that you have the asymmetry on your side. The asymmetry basically means that there's less risk than profit available. So if you are aiming to have, say, just for the sake of simplification, if you are risking $100 to make $100, it's going to mean that you have to have very good track record or success rate is the word I was looking for. So your success rate has to be really high. But if you can risk $100 to make $300 or $500, then obviously you don't have to be so successful in your market timing. So that's basically the idea there. And also because there are those times when the market whipsaws up and down. It moves quickly to one direction and then quickly to the opposite direction and stops you out in the process. So we want to avoid those. We want to find levels and areas where it is easier to stay in the position where you are not a weak holder, but a strong holder of your assets. So and obviously, just one more thing to say about these. It is impossible to sort of weed out all the problems or sort of whipsaw problems that there might be, but we can take certain actions to reduce the possibility of this happening. Now, some people have this experience, and I've had it, not so much anymore, but I used to have this problem. Right after my entry, the trend reverses. This was at the time when I really didn't understand that much about trading. I was looking at the market and seeing this great move, and then I rushed into the position, and most of the time the market just turned and stopped me out. So you might be a buyer in a strong momentum market, and then the market starts to move or lower, or the opposite, you sell, strong sound downside momentum, and then the market just stops, kind of consolidates for a moment, and then moves against the opposition enough to stop you out, and maybe even reverses the whole trend. So obviously we want to avoid these, and there are ways to do that. Just so that I don't forget, a couple of important things to mention here. One of the reasons you might experience this is that if you enter a trade looking at, say, 1 hour time frame, and you see this big candle, and the market has been trending higher, and then there's this big candle up, and you enter a trade and market just reverses there after your entry. One of the reasons might be that you have an important weekly or daily resistance level there. You just didn't do your daily market analysis. Sorry, you didn't do your market analysis that you should do. You should do your analysis on paid daily and weekly time frames also, not only in the time frame that you are trading.
We should choose only one pair for trading.
Oh, hello, hi. You are asking if we should choose only one pair for trading, all right? That was the question, okay? I think that was the question. Okay, cool. Thank you for the question. Could you, in the future, just type your question into the chat box? I will answer it. But just to answer your question, it's a good question, first of all. If everything is relative, and it's like everything else, this is relative to your performance. So if you struggle with your performance, it makes sense to concentrate on one market and to learn the trade, to trade this one market profitably. By adding more markets, because, by adding more markets, you just add more information that you have to handle. You add more burden on on your decision making, really. Because every market has a different style of trading. Every market moves differently. So you might have a DAX that, for instance, that moves really fast. So when it comes to support level and people start buying, it really just takes off quickly. It's a volatile market, not highly liquid, and that's the reason it moves the way it does. But then you might have Euro USD. That is very different market. It just tends to move slowly, and that's because there's a lot of liquidity, and basically this means you have lots of limit orders in the market, and the market has to work through those limit orders before it can have a bigger move. So lots of liquidity, market moves slower, less liquidity, and the market is moving faster. That's the general rule. So this is just an example to highlight the fact that there are different markets that behave differently. So if you find it difficult to be a profitable trader, like most traders in the world basically are not profitable yet, you just have to simplify things. Simplify, simplify, simplify. This is what I find useful. If I find that I'm going through a rough period where I feel stressed in my trading and things don't go right, I concentrate on one market only. I take less trades, for instance. I use higher time frame than usually, and that helps me to see the things what I should be seeing better than I would otherwise. When I started trading, and this is the last comment on this question, I'm going to move on soon, but I think it's important to just mention this for new traders' sake. When I started trading, I thought I have to be trading 16 markets at the same time. I really had 16 charts on my screen. And it was impossible to manage all those markets and understand I opened positions in many different markets at the same time, and it's impossible to manage those positions. Okay, let's move on. There's lots more that we could talk about here, but yeah. The next 10,000 trades. This is a lovely, lovely sort of comment that I heard from somebody. There was this webinar that I was listening to, or an interview that I was listening to, a podcast rather is the word. There was this trader who told about a hedge fund that he worked in. And he said that everywhere in the screens, in the fridge doors, and everywhere they had these little post-it notes where it said the next 10,000 trades. And the idea was that the traders wanted to focus themselves on the process, not the profits. And this basically means that if you are struggling with your trading, one of the reasons might be that you are too focused on your results, on your profits, and losses also. So then you start making wrong decisions because you become emotional, and you focus your attention to your emotions rather than on the market itself. By thinking about those next 10,000 trades that you're going to make, you start to focus on the process. How do you take trades? How do you choose trades? What's your trade selection process like? How do you set targets? How do you manage your trades once you are in a position? Where do you place your stops? Is it good to place them to levels that are close to your entry or further away? Is it good to use trading stops, or would it be better to just give the market more room to breathe? Are you coming out of the winning trades too early? Are you holding your losing trades too long? Are you adding to losing positions? Are you risking more than you should per trade, per day, per week? Are you evaluating your process on weekly or monthly basis? All these questions become very important once you realize that your focus needs to be in the next 10,000 trades. And you should be really asking yourself, is what I'm doing now good enough process-wise so that I can use this for the next 10,000 trades? Because it might not be actually worth trading your strategy. Your strategy might be so flawed that the next 10,000 trades is going to be an impossibility. Okay, there's a question. Please tell us how to take trade with pin bar confirmation on 4-hour and 1-hour charts with support and resistance. Okay, thank you for the question. Maybe I'll leave that for later because I have something else prepared for you, and I have to go through this because I believe this is valuable. But I will remember your question, and I will look into it, and maybe in the next webinar I am going to give you an answer. Let's start with the real basics. The market is moving higher because we have more buyers than sellers, right? And then there comes a point, inflection point or swing high or reactionary high, whichever language you want to use there. But something happens here. Can somebody tell me why is market creating these highs? I have another swing high and there's a third one. Why does market create these? What's the reason? It's good to understand the reasons behind the price action. Because Okay, actually, let me see your answers first. Can somebody type in, why is market turning like this? We all have seen the trend going higher, but why does the market turn at certain points? Okay, I think one of the reasons, okay, supply comes in. There might be retracement level there because buyers are collecting profits. Very good answers. Lovely. Thank you, guys. Exactly. Those might have the market coming to a resistance level. Say this is a weekly high, daily high that we talked about. This is a 4-hour trend here. And the market pauses here, but then breaks through. So obviously some people are seeing this as a level that it makes sense to take some profits off the table. And some people see that this as a shorting opportunity, so the market goes down. There might be a news item here that causes the market to move lower. There could be a breaker structure through, meaning that you would have maybe a support somewhere here and the market comes lower. I think this is what you are referring to, Chris. And yeah, market breaks the support and trades lower. Okay, then I know that a lot of traders are looking to trade breakouts, and I can see a logic there, and we can go more deeper into this later. But what I find a little problematic is that quite often the traders who buy the breakouts, they are buying at quite high prices. They often are buying close to levels where they don't see the price moving further in their direction, and they have to wait and wait and wait and wait quite a long time before their trade is profitable again. And this can be emotionally taxing. This can lead to wrong trading decisions. Obviously, if this is a 5-minute chart here and we're talking about 2 or 3 minute retracement, then that's not going to be a problem. But if this lasts for a few days, it might make you think what you're doing, or for, let's say it lasts for 1 day. It might cause you to question your trade. So, and also one more thing here, you don't immediately see if your trade idea is profitable or not. You have to wait until this low is created and the price bounces higher. Only then you have a confirmation that yes, what you are doing is actually in line with what the market is doing. So I'm proposing this, and I obviously don't say this is the only correct way of doing this, but I'm going to tell you the benefits and then you decide if you are happy with my explanation. So basically, if you wait a little longer, if you wait for a pullback, then you have few things on your side, quite a few things on your side actually. You have the momentum here. The market is moving higher, so you have, one of the, most reliable market phenomenon that you can find in academic literature is momentum. Momentum seems to be pervasive. It just works decade after decade after decade. So if you have momentum, that means that you have money flowing into the market, and that's why it's a good indicator of market doing or market action being something reliable. So if you wait for a pullback here, you have the momentum on your side, you have a higher low nearby, which is a confirmation that yes, this market is really attracting more money and more buyers are ready to defend these levels. Then you have the breakout on your side, that's the third factor, and then you have the market taking out some of the sort of air from the prices, and the price is closer to levels where it is more likely to move higher again. Yeah, exactly. Break and retest. This is one of the most classical and most useful sort of chart patterns that you can see. And I just find that these work. When you see this happening, it's quite reliable. Obviously, there are challenges related to it. Nothing is too easy with trading. Otherwise, we all would be somewhere in Bahamas or something. But if you just wait for those things to come together and then you enter your trade, you have more on your side than if you are just trading a breakout. Then all you have to do is just to keep on repeating the process when the market keeps on moving higher. This is obviously evidence that people are competing to get into this price move. The fact that you have higher prices just tells you that traders can't wait for the price. There's a FOMO, there's a fear of missing out there. And here I have some examples, and these are based on line and close chart just for the purpose of seeing, just for the presentation purposes here. Market breaks the resistance, traces back to support the level that used to be resistance, and then moves higher. The same here. But obviously, there are times when the market just accelerates and you don't have those retracements anymore. It just is the way it is. There's no way of, you just have to accept it. Nothing's perfect. What if price goes lower and breaks the first support to retest the first higher low? It's obviously something that happens, and we're going to tackle that in a moment. So I'm going to talk about the trade entry strategies. So, but if the market goes above this and then rolls over and comes back here, it can be problematic. It is obviously not as clear a signal of market having momentum as something like this here. This is a clear uptrending market that can't stay down. It just has to get higher and higher and higher. So if the market rolls over and comes back here, it can still find support and move higher, but the probability, I think, is lower. So it's just a question of probabilities, really. There's no. One thing I love about trading nowadays is that I don't have to think about trading as being binary, something that it's either wrong or right. So there's no trade entry style that is exactly correct and everything else is wrong, or there's no trade that is the right trade and I mean, if the market, some people think, and I used to think this also, that if the market retraces here, for instance, and then I buy and it moves up, I made the right trade. But at the same time, if I do the same, exactly the same, follow the same process, and the market then just rolls over, it doesn't make that a bad trade. It doesn't make it a wrong trade. If it's according to my strategy and plan, then that is a correct trade, even though the result was a loss. The only thing that matters is the sort of total sum of those next X number of trades. It could be 50 trades. If you evaluate your trading in 50 trade blocks, you just need to make money over the next 50 trades. So it's all about probabilities, and it's all about getting away from the binary nature of thinking that people have. Okay, and sometimes you have situations like this. You get only one opportunity, and then the market just takes off, and you just have to accept it. there's no way of having like I'm going to use an example here. When I was building trading strategies before and programming them, I tried to create something that works in all kinds of uptrending markets, but it's just by definition impossible, because if you have a rule that the market has to retrace back to support for you to enter the trade, then obviously the same system cannot be used to trade situations like these. And so you just need a playbook. There's one. I wish I could remember his name now. Bellafiore. He has Mike Bellafiore. He has a trading firm in New York, and he talks about these that his traders have a playbook. So you have one type of play for one type of situation, and then you have something else for another kind of situation. So that's what you need in situations like these. And then obviously you'll have times when it's only the one shot that you have in the market, and then the next time it fails, the market just doesn't honor the support anymore. And sometimes it's even the first time that the market comes and tests a former resistance and the market just goes through. But we just have to accept this is the case. And if you start seeing these, say, for instance, if the market has been moving like this at first, and then it starts to break the support, then that's a sign of market probably the trend growing old. So the volatility, the fluctuation increases, and it might not be that might be one sign for you to stay away from that market, because it worked earlier, but it's not working anymore. Okay, then the same in the downside. The market breaks the support, rallies back, and that's a good spot for an entry. And I have some examples here. Here the first one is a little challenging because the market moves in your direction first and then moves further above your resistance level. So it's obviously going to cause some challenges in terms of sort of managing this position or placing the stops, but we can go into that a little later. And yeah, there's just another example of a beautiful retracement to your level, and then the market goes through. And the same in the downside, the market sometimes keeps on breaking these supports and doesn't make good retracements back to the levels. But that's again, if you want to be able to trade these, then you have to have a different strategy, different set of rules for that. But in what I'm going through here is an idea that we just only look for these opportunities, and that just fortunately means we have to pass some good opportunities unless we have something else in our playbook for these kind of markets. How do you draw a support or resistance? Okay, that's a good question. Let me go to the next part where I promised to talk about entry techniques, and we're going to finish with this section here. And this is where we tackle this question of drawing support and resistance lines. So there's a couple of techniques that I'm going to talk about here. You have something that, first of all, scaling in entries is something that sort of asset managers in with bigger funds are using all the time. They cannot enter into market on one single mouse click. They have to build their positions over time. Obviously, the bigger the amount of assets under the management, the AUM, the more time you have to allow for entering a trade. So if you are building up a position that basically, if you are just a retail trader entering it with 1 or 2 lot order, that's obviously, that can be done very quickly. But if you have to enter a trade with hundreds of thousands of contracts, then you have to build the position over time. And there's one good benefit in this. And the benefit is that it also sort of moves the trader, the asset manager, away from the binary nature of human mind. We tend to think in terms of black and white, 1 and 0. But the further we get away we get from this mentality, the easier the trading is. So scaling in entry and then confirmation entry. Let's talk about those two. And charts here. So here I have Euro USD in 2-hour time frame, and I'm going to make this a little bigger and wider so that you can see this. So here we have a couple of levels that resisted the price move. Obviously, it's just to give you some background, the price was trading lower and then it broke out from, oops, get that high, broke out from this wedging formation here. And obviously, when you have something like this in the background, it is more likely that the market is actually going to maintain the upward momentum. But then there was this level that clearly resisted the price move there, and then this level that resisted the price move a couple of times. And this now sort of addresses the question that there was in the chat. And the question was, how do we draw support and resistance levels? And the answer is, there is support and resistances are not levels, they are zones. You find that if you go and study the charts, and this is why I'm using this here as an example. You see that the market clearly finds resistance at 2 different levels here, and it takes time for it to work its way through. But once we have a good rally above, then the market is set up for what we have seen here before, the slides that showed you first. So now, first of all, the scaling in entry. Obviously, we want to be buying here, somewhere here. But we don't know if the market is going to come all the way down here and then bounce higher, or whether it's going to go to the next level and then bounce higher, or whether it's going to go through and then bounce higher. So this is the challenge here. So how do we address that challenge? And one of the ways to address it is to use scaling in entry, because then you don't have to know where the market's going to turn. So let's say that the first level we want to be a buyer is somewhere fairly close to this level at, okay, that's 1823. First entry at 1825. Then we decide that if the market comes lower, then we're going to enter the next one somewhere here in between. That's a little bit too close, actually. Doesn't make sense to have. So right next to each other. Let me just drag this a little lower. Let's say that the next one is at 1817 or so. And then we have one level again here. That's So about 7 pips apart, all of these levels. And once the price starts moving, and approaches the level, we don't have to worry about exact level where it's going to turn. Now we have two entries, maybe. Okay, that's it. The price didn't take our third one, but that's quite okay. So this is now you can see sort of benefits and the weaknesses of this approach, because you don't. First of all, the benefit was that you don't have to decide the exact level where the price is going to turn. But then, excuse me, the other sort of the negative side is that you don't get all the limits that you had placed here. Market turned higher, but who cares? You just made money. That's the most important thing. Any questions on scaling in entries? Obviously, one of the questions I would have is where would I place stops? And I think placing stops is an art on its own, and we should really have a webinar talking about stops only. But as a rule, I never like to risk more than 1 or 2% per trade. So I have a spreadsheet which I shared in the previous webinar, which I use to calculate where the stop should be if I'm risking only 2%, or how much position size, rather, that's a better way of putting it, how much size I can put on here if I want to have the stop at meaningful distance. Say that the stop, I decide to place the stop below these lows. And let's have this as a solid line and red. So that's the stop level at 1793, and the mid price here is 1818. So I can calculate using the spreadsheet based on these that what the position size should be if I don't want to exceed 2%. Okay, how will you manage entry volumes as per your capital? Okay, that's exactly what I was talking about. I don't want to risk more than just 1% or 2% per trade, depending on my conviction level on the trade. If I'm really convinced, then that's 2%. If I'm little doubtful, I go with something like close to 1% or 0.5% even. If you have a very small account and you can enter with small lot sizes, you can still obviously sort of the rule of thumb is that the closer to the trade sort of significant support you can buy, the better it is for you. But another entry here, which I'm going to mention before I forget, and then we can come back to this question. Another entry here would be a confirmation entry. And I used to favor very small time frames for confirmations, but I find that they just give too many wrong signals. So in this case, the confirmation entry would be here. That's when the market creates the first upward candle. And now we obviously don't want to trade if the candle closes very close to the next high. If this happens to be one of those very wide range candles that closes close to this high, because there's a risk that this high is a resistance that sends the price down again. I can't remember if that is the case now, but that's the risk. So we want to have a close that is not too far from this support area and still has some distance, there is some profit to be made to the next resistance. So this candle here would be the confirmation entry. And then obviously you need to check that, okay, if your entry is 1835 or so, and the stop goes below this candle at 18, let's say 1805, so you have 30 pip stop, then you can use my calculator and actually send an email to support@tomarkets.com, and we can help you with that calculator. But if you go and if you go and watch that webinar, the previous one, and you can email our support people and they will send the webinar link to you, then you can see what kind of sorry, what's the word? This is not my first language, so formula is the word I was looking for. So you can see what formulas go into the spreadsheet, and then you can build that on your own. It's nothing too complicated. Okay, I think this is if you have only if you can only trade one lot. Say, for instance, you have a $500 or $1,000 account, and you don't, you would like to trade with sort of scaling entries, then I would say go and trade Euro USD, because this market moves very differently compared to a market like DAX or gold. Those markets can whipsaw more easily and take you out. But if you can make money with Euro USD steadily, and say for 3 months or 6 months, you steadily make money in Euro USD, you increase your account, then you can go to gold and add a little bit into gold trading, because you have mental capital that you build up with Euro USD, and you also have the actual trading capital that you can risk with gold. And then you trade very small sizes in gold, and you can trade bigger sizes in Euro USD. That's how I would handle that problem. Okay. Now, before we finish, let me just remind you that TO Markets is amazing. You can trade without monthly fees. If you have a VIP account, there's no monthly fees, no per trade fees. You only pay the spread, and it's amazing because you can decide to trade 500 times per week if you wanted, and there's no per trade fees. You just pay the spread, and that's it. And so come to TO Markets, open account, because you can have a absolutely great trading environment, and you can also have my analysis that supports you in trading. Go to Telegram and subscribe to the Telegram channel that we have. I'm going to give you the link in a moment. Let me see. Add it somewhere here. Moment. I'm going to paste this into the chat box. Yeah, there we go. So that you can get an alert each time there is new analysis published on the website. So, excellent. We've spent a little more than half an hour. This is what usually happens. I'm sorry, guys. I just like to talk about trading, as you can see. So, my apologies. But do you have any questions, or shall we just call it a day and then move on? No questions coming through. Okay, so I'm just going to say thank you for your time. Trade safe, never trade without stops, and don't risk too much per trade. And keep on learning. Make sure that you are better every day. Lovely. Thank you for your time. And oh, There's one more question. Which of the two entry options will you recommend? It really depends on what you like, what you find that works for you. It's a mental question because these entry techniques are a little different. If you have a high conviction on a level, then you can start scaling in little by little, and you can see how the market reacts to that level. You gain more information from price action, and then you just build up your position and see what the market does. If you want more confirmation from the market, then you use the confirmation entry, but then you pay a higher price. And that means I would use more position with the latter option. So maybe I would risk 2% with the scaling in and only 1% with the confirmation entry, because the entry level will be higher then. Anyway, thank you guys. I look forward to seeing you in the next video, and go to our YouTube channel also, just to subscribe to it, so you stay up to date with the videos over there also. Lovely. Thank you for your time. I look forward to seeing you soon again.